As the year approaches its end, Wall Street's finest are bombarding clients with thick reports prognosticating about the opportunities to profit in 2016. But the money managers have a different sort of report to produce, an explanation to their customers of why they made so little money in 2015. In reality, the explanation is pretty simple. The benchmark for developed country shares, MSCI World, you can see that is the blue line on here, that's completely flat for the year, almost exactly. Benchmark for bonds in the world's biggest reserve currency, 10-year US Treasury, I've got the yield for that on here in red, that again is flat. Started out the year yielding 2.171%, and I have to be that precise because it now stands at 2.178%. We need that third decimal place in order to see the difference. Active traders who made the right calls, no doubt after watching these videos, could have made money from the big swings along the way. They really were quite dramatic, particularly early on in the year in bonds and then in the summer and late autumn in equities. They could also have hedged against a rising dollar and made lots of money from areas like Europe where currencies fell hard. But for a standard dollar-denominated buy and hold portfolio without major currency bets, there were two big opportunities to make money this year, and both of them were far from obvious: Japanese stocks and long-dated index-linked British gilts. Now, Japan's an unlikely choice to be the best performing major equity market, at least after adjusting for the currency, not least because it had yet another recession in the form of 2 quarters of falling GDP. But simply buying the Nikkei at the start of the year would have returned 12.5% in dollars, including dividends. That's a gain beaten only by a handful of small countries, including Jamaica, Hungary, Ireland and Denmark. Now, the year was also dominated by tumbling inflation and talk of secular stagnation, so it's rather surprising that gilts with inflation protection did so well. British government bonds are seen as one of the safest holdings out there, and adding in inflation protection makes them even more boring. These aren't investments to put the fun in pension fund, but the index-linked gilt maturing in 2068 has risen in price, if I move it over to the next chart, risen in price by 16% this year. That's the blue line there showing the price. Now, that gain came after a whopping 44% gain last year, and that bond now yields 1 percentage point below inflation, locked in for the next 53 years. Hardly a bargain. Part of the explanation is the demand from pension schemes, who care much more about hedging liabilities far into the future than they do about the price. Intertwined with that is the surprising rise in bond market-derived inflation expectations for the next 30 or 50 years, even as inflation expectations priced into 10-year bonds have fallen. Now that expectation is taken by looking at the nominal bond yield, the ordinary bond, and then taking away the inflation-linked yield. Inflation-linked yields did fall fast, but yields on long-dated ordinary gilts fell by even more, and so that inflation expectations moved. Now, after gains like this and such an awful yield, it's hard to believe that the long end of inflation-linked gilts is a good place to invest for next year. But that seemed obvious at the start of this year as well.